We're going to turn now to Meera. Meera is an executive director and a global market strategist on the JP Morgan Asset Management Global Market Insights Strategy team. She's responsible for delivering timely market and economic insights to institutional and retail clients, conducting research on the global economy and capital markets, and running economic forecasts. She's responsible for publications like the Guide to the Markets, which I mentioned a few minutes ago, and is a contributor to the JP Morgan Long-Term Capital Market Assumptions. That's another very important thing that we use, the long-term capital market assumptions. JC and I use those long-term capital market assumptions when we do financial planning for you. We have to make assumptions about what returns on your portfolio might occur so that we can project forward whether you have a successful financial plan, and the source of those estimates on the securities comes from JP Morgan. And we also a few years ago did some research to see, well, how accurate are those estimates, right? They can make estimates, but are they good estimates? And we found they're pretty good, right? We wouldn't be using them if we didn't think that they did a pretty good job of forecasting. And that's not easy to do. And they forecast, you know, what are stocks going to return, what are bonds going to return, and not just general like that, but, you know, what are high yield bonds going to return, what are international stocks going to return. They get very granular, and that's very helpful to us doing our financial planning work. Meera joined the firm in 2011 as an analyst and in JP Morgan's private bank, and she served ultra-high and high net worth clients. She's held business strategy roles in the asset management group in New York and London. She earned a BA in English from Tufts University. Anybody go to Tufts? No? Anybody have kids or grandkids at Tufts? No? All right. And she holds Series 7 and Series 63. She is a CFA charter holder, and I want to thank her very much for being with us this morning. So I'm going to turn it over to Meera now, and she's going to talk to us about investing against the wall of worry.
Good morning. Thank you for having me. Yes, there is certainly a wall of worry, and it's actually been a pretty bizarre year in 2023. You know, I'm thinking about some of the polling results, and if we had said a year ago or 2 years ago, in the fall of 2023, we will have interest rates at 5.5%, but we'll also see annualized growth in the US economy at nearly 5%. I think we would all be scratching our heads as to exactly what is going on in the economy at this point. And we've had a lot of headwinds throughout the year. So if we go back to March, we had the regional banking crisis. Then in May, near collision with the debt ceiling. This summer, credit downgrade. We almost had a government shutdown in September. We still may have a government shutdown in November. Of course, as you all mentioned within the polling results, challenges with the Speaker of the House, and now also geopolitical issues with the Israeli-Hamas war overseas. So definitely a lot of big looming macro risks. And yet 2 things have gone right for the economy and markets over the course of the year. And that's really helped from an equity standpoint, where markets are up about 9% year to date. The first thing was economic growth remained strong. In fact, we've actually seen a bit of a reacceleration in economic growth. Contrast that with the fact that we all thought we were probably going to go into recession this year. And the second thing that's gone right is inflation has come down. Although it's getting a little bit stuck around 3.5, and we have some progress yet to make, we've still made some pretty good strides over the course of the last year, going from 9% inflation, again, to about 3.7% today. Not done yet, but that has been helpful because it's alleviated some of that pressure from our central bank, the Federal Reserve. So with growth and inflation trending in the right directions, while that's put some upward pressure on things like bond yields, at the same time, it has very much helped the equity market settle down and produce some decent returns. So I want to talk a little bit about and hopefully address some of the year ahead polling questions as well, where we see things going forward. What's going to happen with economic growth, where we see inflation, the Fed, and most importantly, how do we think about portfolios in this environment? So if we take a look at the slide ahead, this was supposed to be the recession year. And in fact, even in the later parts of last year, we were thinking could tip into recession. And even with the banking crisis back in the spring, it didn't feel at the time like recession was all that far off. But what we've seen is a very resilient economy. So keep these two numbers in mind. Usually the economy grows at a rate of about 2%. But recently, and this morning, the third quarter number came in at 4.9%. So more than double the growth rate of the economy typically. And a lot has gone right for the economy itself. About 66% of the economy is consumption. And so what we saw is still a very strong consumer. Yes, there are headwinds to the consumer when we think about consumers taking on more debt, having less savings, student debt payments coming back online. But we're also seeing a big divergence underneath the surface in terms of different income and wealth quintiles and who's able to continue to spend and who's not. And I think what we saw in summer in a large part was the upper income quintiles and quartiles were spending a lot of money on travel, restaurants, entertainment. So while the lower and middle income segments were starting to scale back, you didn't see that among the wealthiest. And ultimately, when we look at consumption, it's at a high level. It's not by different cohorts. It's the dollars and cents going into the economy. So that helped quite a bit. What we also saw was businesses continued to spend, whether it's investing in things like AI or taking advantage of some of the different government subsidies from the CHIPS Act, the IRA Act. We've seen quite a bit of spending from the business side, which again, if you think about having a banking crisis back in March, you'd expect those banks aren't going to lend, and that's really going to affect small and medium-sized businesses. But that hasn't entirely been the case. And the other thing we've seen is that the deficit has come in much higher than we've expected, basically double what we would have expected for the year. And what that means is that in the short term, that has also boosted growth. Now, I wouldn't say that's going to be a great long-term driver of growth. Deficits are set to be anywhere between 5 and 7% of GDP going forward. Typically, you'd expect the deficit somewhere more like 3%, or hopefully you wouldn't have one. But we're expecting some pretty hefty bills coming over the next decade, and a lot of that is going to go to interest payments as we finance our debt at more expensive costs. So I don't think that will be a longer term source of growth, but in the short term, that has helped. So many of the different components of the economy have continued to hum on all cylinders. We often reference GDP numbers in terms of how growth is shaping up. But I think this slide here and this chart in particular just helps to give a sense of where economic activity is and why we might still be able to avoid a recession for the rest of the year and perhaps for parts of next year as well. So what we look at on this slide is recession indicators, because a lot of people think a recession is just 2 negative quarters of GDP growth. But the reality is there's actually a decision-making body called the National Bureau of Economic Research that looks at a couple of different factors when they decide, okay, do we think we're going to go into recession or not? And the 6 factors that they look at in particular are on this slide here at the top. So they look at income, they look at 2 different measures of jobs, consumer spending, retail sales, and industrial production. And so what we've done here is we've taken the monthly prints and looked at them on a month-over-month basis to see what the change was. And then we formatted that in a heat map. So, if you think about it like a lawn, green is growing, yellow is kind of slowing down, dying out, and red is definitely not a good thing. So what you see here is a lot of yellow and a bit of light green too, all the way towards the right when we look at where we are today, with most of these areas looking still okay. And if you look at the bottom chart as well, what you can see there is just look at the last 6 months, what the change has been, and almost all of these measures are still, again, increasing as opposed to moving in the other direction. Now, does that mean things can stay hot and things can stay healthy? I think about the economy a little bit like the banana you left on your desk on Friday. It was perfectly ripe, and then you come in Monday and it's a bit rotten. So we have to be cognizant that the economy is somewhat similar. It can go from ripe to rotten pretty quickly. And none of the risks that are on the table at this point have been eliminated. I mean, we still have higher rates, and we're likely to see those rates stay at a high level for a period of time from a policy perspective. We have less lending going on, slower profits, and again, some various headwinds to the consumer. Now, it could take a while to reduce growth in a meaningful way. So maybe we see more of a slowdown instead of a definitive recession next year. But nonetheless, I think that there's still some challenges on the horizon. So unless you can say we've eliminated risks, I don't think the risk of recession is off the table for next year. So good for now, better for longer, but not better forever. Now, on the inflation front, inflation is down, but it's not out. And what you can see on this slide here is we look at two different measures of inflation, headline CPI in blue, which is general prices across the economy, and then core CPI in gray, which is ex food and energy. The way you can think about that is really food and energy are quite volatile. They're not something that the Fed can really control when they raise or lower interest rates. So sometimes the Fed likes to look at what's outside of some of those more volatile commodity categories. But the trend is pretty consistent with both. And I think that while people have been frustrated with the path of inflation, if you look at it, it's kind of following the pattern that it always does. When we have an inflation spike, we actually tend to see inflation come down pretty sharply and almost symmetrically to how it rose, kind of Eiffel Tower, mountain peak type of shape. And that's the experience we've had thus far. But I think about being at nearly 9% last summer and June to about 3.7% today, if we look at overall inflation, including food and energy. And when I think about getting to the Federal Reserve's 2% target, it's kind of like when you have a pretty ambitious weight loss goal. Maybe you want to lose 20 pounds, and the first 15 pounds is not so bad, but the last 5 takes the longest. And that's kind of where we are with inflation. We're at the last 5 pounds to really get all the way down to 2%. And so it could take, again, slower growth, another year to really get to that point. But we do think we're making progress because compared to last summer, we have made some progress on some key areas. Although there's still some volatility in commodity prices, there's a greater amount of stabilization than there was last year with the onset of the war between Russia and Ukraine. If you look at things like supply chains, those have also normalized to a large extent. In fact, now we have a little bit too much inventory that companies are trying to reduce. And then if you think about spending patterns of consumers, during the pandemic, everybody wanted goods. The Pelotons, the laundry machines, big ticket items, entertainment at home, things like games and gardening equipment. And nobody really wants those things anymore to the same extent. So that has dampened some of the prices in the goods sector. The areas where we're still having trouble that we need to solve in order to get from 3.7 to 2 are really around services. So one, the category that I mentioned in terms of restaurants, travel, entertainment, that has seen quite a pickup over the summer, somewhat seasonal too. I think that we will probably end up seeing slow down over the course of the year. The reason I think that is one, I don't think that there's all that much consumer power in terms of firepower left as people are relying more on credit and people are really getting a lot more judicious with their spending. I mean, again, while energy prices have normalized a bit, they're still expensive. And that means that the average consumer might need to cut back on other areas in order to make sure they can fill up their tank. So I think you're going to see some of those categories gradually start to decelerate. And then the biggest issue with inflation right now, and this has been consistent for almost a year, is that we have still very high shelter costs. And when I say shelter, we think housing, but actually the way inflation measures shelter is really more about rents, just because housing is considered more of an investment. And so they're sort of thought of a little bit differently. But the problem with rents is the way they're calculated in this particular index is very theoretical, doesn't really reflect the fact that we're actually seeing some deceleration in rents across the economy and a lot of supply of apartments coming to market across the United States. So that should help bring down some of those shelter costs. Now, I do want to reiterate, inflation is different than price level. We're not going to see the price levels that we saw during the pandemic, and I wouldn't expect price levels to come down. But the rate at which they're increasing, I think, can slow more and get closer to 2%. So some progress to be made. Got to lose that last 5 pounds. It'll take a little bit of time, but we can certainly see the scenarios in which we make some more progress. Now that brings us to our central bank, the Federal Reserve, which has hiked rates really sharply over the last year and a half. So we started in March 2022 at 0% rates. You can see that in gray on this slide here, where we look at the policy benchmark rate. And they got to about 5.4% most recently. So that's where we are today. But where do we go from here? If you look at the blue line and the green line, it shows Fed expectations of where they think we'll go in blue, and then market expectations of where we think we'll go in green. And the Fed has said perhaps we could see one more rate hike. Now, the Fed meets next week. That would typically be when they would hike rates if they were going to. But the Fed is also usually pretty good at forecasting, okay, we're going to hike rates or we're not. They didn't really signal that very strongly. So I think they probably will not hike rates in November. But they meet for the final time this year in December. And I think that there is a risk that they hike one final time. And the reason is the Fed has said we're making our decisions based on incoming data. And some of the data has actually continued to be a little bit hot. If you look at things like inflation, we're not making as quick of progress again here as we'd like to see. If you looked at this morning's GDP report, again, 4.9%, a really strong growth rate, that can tend to correlate with higher inflation. The job market has been strong. Recent consumption numbers have been strong. So there's still a chance that the Fed may raise rates one more time. But I think what is important about where we are today is that relative to last year, where Fed rate hikes had a really negative impact on markets, this year it's been somewhat less so. We've still seen a lot of volatility with interest rates, but on the equity side, less so. And I think the big reason is that blue line and that green line are fairly close together. Last year, they were miles apart at different points. Sometimes the Fed was higher, sometimes the market was higher. And the problem is that breeds uncertainty and surprises. And very much what we've moved from is the phase of power to finesse when it comes to Fed hiking last year versus this year. So although we've probably seen more rate hikes this year than we originally expected, it's really more about fine tuning here on the margins in terms of rate policy, and they're getting close to being done. So I think by the end of the year, they will have finished their rate hiking cycle, which shifts the focus to what do they do next year? And what they've said they'd like to do next year is higher for longer. They don't want to cut rates anytime soon. And they really don't want to cut rates until we have some sort of imminent fear of recession, until we're right on the brink of it. So given how much the economy does have to slow in order for us to get to recession, it is possible that the Fed doesn't get a chance to cut until the end of next year, potentially even the following year. It's really all going to depend on the strength of the economy. What we have seen in the past is that the Fed typically tightens too much. It does push the economy into recession sooner than they think, and then they're forced to cut rates in order to help stimulate and support growth again. So that is still on the table. So we're not exactly sure how things will play out, but the Fed has said they intend to keep rates higher. And I think that relates back to something that Leonard had said up front about bond yields. When we think about positioning in the bond market and within fixed income. Because if we look at the earlier part of this chart, not too long ago when we were at zero rates, and then a couple years before that at zero rates for a long period of time, the Fed had kept rates at a very low level, and therefore yields overall in the market were at a very low level. I think this time when the Fed eventually does cut, they might want to cut down to like 3% at most, but they're not going to want to cut all the way down to zero. And in fact, the less they have to cut, the less they'll want to do. And so that's going to put a real floor on how much yields come down. And there are other pressures on the market, different technical factors like a lot of supply. Again, think about all those deficits that we're going to have over the next couple of years. That is funded by borrowing, which means more and more treasury issuance, which means more supply. When there's more supply than demand, that's going to create some challenges for yields. So I want to be cautious in the fact that I don't think yields are going to come cratering down and we're going to see the type of rate environment that we saw over the last 10 to 15 years. But even a little bit of movement in rates can actually benefit your bond portfolio quite a bit. And we didn't plan this, but Leonard kind of mentioned it up front. If you look at the next slide here, there's a different trade-off in terms of risks, because I think people think about last year and how miserable an experience that was from the bond market perspective, seeing way more volatility and a much bigger drawdown in the bond market than we would typically expect for an asset class that tends to be less volatile. But as rates move higher, the risks start to change. And so I know there's a lot of data on this slide here. What I'd like to draw your attention to is just the right-hand chart. And if you look at the middle of that right-hand chart, let's just use US aggregate as an example. That's a broad universe of US bonds. What you can see here is that the risk reward is different based on where we are from here, given how much yields have already risen. So for example, if you look in blue, you can see the impact of a 1% rise in rates. So if we're at ballpark we're at, as of this slide, 4.9-ish on the 10-year. If we saw a 1% rise in rates, that would give us 5.9. If we saw 1% fall, 3.9. So you can see that in gray and in blue, the impact there. And so if we saw a further rise of 1% in rates, which we do not think is on the table, maybe we see another 20 basis points, maybe the treasury yields go slightly above 5%. But if we were to see almost 6% rates, you'd actually be looking at a drawdown of about 0.5% on bonds. And the reason is, although when yields rise, bond prices fall, you're also getting a really strong income component at this point. So it will offset a lot of those losses. We did not have that advantage going into 2022. And now we do. We have a bit more of that cushion. And you can see that if we actually see a fall in rates to barely below 4%, which again is historically high in the context that we've been living in for the last 10 to 15 years, then you'd be looking at somewhere between an 11 and 12% return, because yields come down, bond prices rise, plus you have 5 to 6% of yield at this point in that income cushion. So on a total return basis, you could be looking at double-digit returns, even if bond yields only go down to slightly below 4%. So again, going back to that polling question where people think things could go down to 2 or 3, I don't know if they can go down that far. I think the economic damage would have to be pretty severe, but you can see how that return would increase when you have bonds that have a little bit of a longer shelf life than what you might have been holding over the last several years. So that's how we're thinking about adding to core bonds, an area that's actually more attractive than it's been in a while. Now, because of rate rises, that has made the bond market pretty cheap. We definitely want to gear more towards the higher quality areas of the market. But on the other hand, the equity market doesn't look all that cheap. And I think a big reason why is the fact that we've had a very lumpy performance within the equity market this year, where a very small number of stocks have driven most of the gains. So what you can see on the left-hand side is we look at the top 10 stocks in terms of valuation, the price to earnings ratio, basically whether stocks are expensive or cheap, in green, and then we look at the valuation of the rest of the market in gray. And what we see here is that those top 10 stocks, which include a lot of those mega cap, big tech stocks that we've been hearing about all year that have done fabulously well, those are about 37% more expensive than their long-term history. If you look at the rest of the S&P 500, it's about 1% more expensive than the long-term history. So that top line valuation number doesn't tell the full story because there are two different markets going on underneath the surface. Now, the problem when you have the top 10 stocks at such high valuations is that things with higher valuations tend to be the most vulnerable to correction when sentiment turns, when the economy turns. And that's actually what we've been seeing over the last couple of days, where those bigger tech stocks that are big portions of the index have actually been facing some challenges, as the outlook from their earnings perspective looks less bright than it does today. So the fear there is that you have a little bit of an accordion performance here, where those top 10 can get very extended in terms of valuation, but come right back down to meet the remaining stocks. So we want to be a little bit careful about valuations and where stocks are expensive in a concentrated part of the market. And speaking of concentration, those small number of stocks are quite concentrated in the index overall. And I think that that's a departure from where we are typically within the market. So if you look at the chart on the right, what you can see is the top 10 stocks in the S&P 500 are about 1/3 of the index. And you can see here that is historically high. And if you brought this chart back further, it's really the highest it's been since the 60s. And the problem there is, if you have a day like yesterday, where a stock like Google had the worst performance it's had in a year and was down pretty significantly, you're going to experience a lot of volatility in your portfolio because you have a very concentrated position. So a lot of performance is driven by a few number of stocks. Now, a lot of people have said, yes, but these are such high quality companies. They have such great earnings. And that is true. And they are good things to own for the long term. I think we need to be a little bit more selective, though, in picking between which ones we overweight and underweight, because this is not a untouchable category anymore. If you look at the bottom chart, we look at the earnings contribution. How much of the overall profits are these top 10 companies producing? And it's about 20%. So it's 1/3 of the weighting of the index, but only 20% of the profits. If those two numbers are not commensurate, you want to think a little bit about how you're diversifying. Now, I will admit it is a really challenging environment in terms of finding diversification within the equity market because these small number of stocks are so dominant in the index. But I think the way we're considering it is it's not about sectors, it's not about styles. You're seeing a lot of divergence underneath the surface, even within sectors and styles. So we're thinking about being active on a stock level, which means looking for areas where the relative pricing looks favorable and looking for areas where we're hearing from company management that profits look okay and that some of the headwinds that we're going to be experiencing in the coming years are going to be managed reasonably well. So it's not really the environment of the last 10 to 15 years where rates are low, stocks can do well pretty much no matter what. We have to be a lot more thoughtful in our equity allocations going forward. Now, a lot of people say, okay, fine, I don't feel that good about the bond market. I don't feel that good about the stock market. It's not an easy investing environment. I'd rather just own a CD that's going to pay me 5% and call it a day. And I do think that cash has become a more attractive investment overall because no longer are you essentially losing money on your cash when you subtract out inflation. But having too much cash for too long comes with a pretty big opportunity cost. And so what we've shown here is we look at the peak CD rate. You can kind of see those smaller gray diamonds there. We look at the largest or the highest the CD rate got during prior Fed hiking cycles. And then we look 1 year later. What was the return in those 6-month CDs? What was the return in aggregate bonds in navy, in high yield bonds in blue, and in the S&P 500 in green? And what you can see here is at best in your CD, you're going to lock in that 5% return. The problem is if it's a 6-month CD, you're locking in about half of that today. But in 6 months, if yields have started to come down and rates have started to come down, then you're getting something less. So they have a bit of reinvestment risk there. And that's why you can see in certain cases, the actual return for the year later is less than what the rate was to begin with. But, if you think about the other areas of the market, what goes up must come down. And when you think about the peak CD rate, that's going to mean yields across the economy are probably at the highest levels that they're going to be. And again, when yields come down, bond prices rise. So if you look at something like the aggregate bonds in navy, sometimes you see some pretty outsized returns. In fact, in every of these instances, beating the cash rate there because you not only get good income that you've locked in, but also you get the benefit of capital appreciation if those yields do come down. And you can see a similar story too in some instances in high yield in the S&P 500. They're a little bit riskier. So you have to consider that as well. And sometimes the timing can be a little bit different based on what's the entry point you're getting. But in many cases here too, you can see some really outsized returns. So it's not always easy to predict what's going to be the outperformer, but you can see across the board here that there is a pretty big opportunity cost to sitting out in cash too long, which again, we've already seen this year actually in the equity market and the high yield market, which have both done pretty well. Maybe I'll end on one more slide, just in terms of thinking big picture about portfolios, portfolio construction, some of the headwinds that we have been facing. And something actually another advisor had said to me, which I thought was a really good way of thinking about market returns versus economic outlook, is that the markets and the economy look in opposite directions. Markets are forward looking, whereas the economy is at best looking at where we are today, but probably looking at where we were a month ago or a quarter ago when we think about the lag with which you get some of those data releases. And I think this is helpful in thinking about diversification because diversification has obviously come under quite a bit of challenge over the last year. It's starting to recover, but I think that people are still feeling a little bit burned from last year. But what this chart shows is a 60-40 portfolio, 60% equities in green and 40% bonds in gray. And it shows the calendar year return each and every year back since 1950. And what you can see is last year we were down 16%. It was the worst year for the 60-40 since 08. And 08, you can see there down 20%. And then if you cast your eye all the way back to 1974, the year where we were down 17%, that was the last time that both stocks and bonds were negative. So having that outcome like we did last year is pretty unusual, not worth re-evaluating your entire portfolio for something that happens relatively rarely. The other thing I'll say is once you have these big reset years, typically then you're on the path of recovery. And it doesn't even mean that the economy needs to be signaling an all clear. Because what you can see in 1975 is that the economy, that was not a good year. And yet the 60/40 portfolio was up 28% with both stocks and bonds positive. And then if you look at 2009 after '08, we were up 18% and both stocks and bonds were positive. And 2009 is a good test case because markets bottomed in March. We didn't get out of recession until the summer. And actually, the unemployment rate continued to rise and peak in October. So markets price in a whole lot of bad outcomes. Some of them crystallize in the months and years ahead, some of them don't. But markets kind of move beyond from the economic outlook. And I think that's what started to happen this year, where last year was a brutal year for diversification. But this year, you're starting to see that recovery. And you're starting to see that yin and yang a little bit more. Bonds not doing so great, but equities balancing that out. And I don't think we're going to see a linear recovery in the portfolio going forward because, look, there are still headwinds ahead. But I do think that this is the beginning of a longer term recovery in portfolios after the shock that was last year. So with that, maybe I will pause there.
Meera, thank you very, very much. We've got maybe just a few minutes. Anybody have any questions? Meera, the question is about recent weakness in the market. Things were going strong, and then over the last couple of months, less so.
So I think what's sort of started to tail off is coming into this year expectations. It's all about expectations and what people think is going to happen versus what starts to happen. And the expectation was any minute we're going to be in a recession. Any minute we're going to be in a recession. And then what happened is, again, growth was pretty strong. Inflation continued to come down. So some of the big fears and headwinds actually weren't as prominent. So markets started to do pretty well because all of a sudden you had a nice upside surprise for equities when they were not anticipating as strong of growth. I think what's happened to help them turn around for the worse in more recent weeks is the fact that then expectations all of a sudden got ahead of themselves. People said, okay, profits are going to be great. Maybe we won't go into recession at all. The Fed will pause and we'll be, everything will be perfect. And the problem is when you have higher growth and the Fed starts to get worried about higher data, they've been non-committal about ending the rate hiking cycle. And we've continued to see a number of headwinds happen within the rate market. So we were back at 3% yields in the bond market just a few months ago. And now we're really flirting pretty closely with 5% and could see things tip over. And the rate environment does impact equities because essentially it says, well, your valuation on a company is X, but you have to get over a hurdle rate of what the rates are. So as rates go up, it sort of raises that hurdle rate. And suddenly, all of a sudden, companies better be producing really attractive profits in order to earn the prices that they have. So rates do put pressure on equities. I think the two big reasons why we've seen equities turn around over the last, call it 3 months, is one, that rates have moved higher and very fast. I can't underscore how much volatility there has been in the rate market and how unusual it has been to see rates move 1% over the summer. And two, people started to get ahead of themselves in terms of expectations of everything being great. And I think the reality is, I think we're at the high water mark and the outlook going forward is going to look a little bit more challenging. And you're hearing that a bit from companies throughout earnings season saying things are good today, but we're a little bit worried about tomorrow.
Any other questions? Meera, thank you so much for your being with us today, your incredibly insightful remarks. We really appreciate it, and we value our work with you.
Thanks so much for having me.